to the last panel of the day. We're between, right before drinks, so we'll make it exciting and fun. And thank you for spending time with us today. I think we win, hopefully, I think we win for the longest commute to today's session. So I'm Steve Fleishman from Wolfe Research. I cover utilities, clean energy, midstream at Wolfe Research in New York. Really, really happy to have the CEOs of PG&E and Exelon here with us. So Patti, Poppe, CEO of PG&E, Calvin Butler, CEO of Exelon, two of the real industry leaders for us in the U.S. And it's kind of a dichotomy. It's probably been one of the most exciting times, I think, to be a CEO in the sector. Elon Musk and Bill Gates even come to the EI conference.
That's right.
But at the same time, the stocks haven't been doing very well.
Thank you, Steve.
So hopefully at some point that converges together.
It will.
But one of the great things about Patti and Calvin is they haven't been utility executives their whole life. They've got a varied background. So I'm going to first let Patti and Calvin introduce themselves and talk about their backgrounds, and then give a brief, I know many of you are very knowledgeable, but a quick review of your companies, and then we'll have a good discussion. So
Okay.
Patti, I'll turn to you.
Great, thank you. Well, it is truly great to be with all of you here today. This is our kind of people to meet with, so thank you for taking the time to come here today. My career is a little different. I started my first 15 years in automotive. I built cars for a living, and learned lean operating systems and what it feels like to work in a competitive industry who has continuous competition. And so I've been able to bring that to the utility sector, and it's been a joy to be able to unlock the potential of our people through a lean operating system. I was CEO at CMS Energy for 5 years. Prior to that, I ran operations for CMS and ran some power plants for DTE Energy, and really learned, I say, the industry through the eyes of an operator and through the boots of an operator, I like to say. I'm still more comfortable in a pair of boots than a pair of high heels. So I definitely consider myself an operator and a lean operator at that. So it's been just a joy to bring the quality principles and the lean operating system to the utility sector. And I joined PG&E. This is my 4th year at PG&E, which is sort of surprising to me that time has gone very fast. And we've been up to some real good at PG&E. We're a combined natural gas, electricity utility. We have 4.6 million natural gas customers in LDC, and then 5.5 million electric utility customers. We serve about 2/3 of California, from, I say, Bernie to Bakersfield, but if you don't know California, you have no idea what I'm talking about. But that's 2/3 of the 5th largest economy in the world. And we have a real ambition to deliver the energy transition. And so I think it's one of the important investment theses at PG&E. Now we're on track for a significant turnaround. We were deeply affected by climate change and wildfire. Specifically, the company went through a bankruptcy between 2019 and 2020. I joined the company shortly after that bankruptcy to really turn it around. And I think the thing to know is just a quick story I tell. My current board chair, Bob Flexon, said to me when he was recruiting me for the job, I asked him actually, is this a financial turnaround or an operating culture turnaround? Because if it's financial, I'm really not your gal. But if it's an operating, we want to make a great company who's going to deliver sustainable results and transform the culture of this company so that it can both be safe and resilient and deliver the clean energy transition, then I'm in. And maybe it was my answer, but he assured me it was an operating turnaround. And so it's been a pleasure to be at PG&E during these years. And we've made significant progress on that turnaround, dramatically reduced our wildfire risk exposure, and have leveraged some really important legislative work that differentiates California on the wildfire risk spectrum. And I'll be happy to take questions about that. We can talk further about the wildfire mitigations that are in place. But certainly at the tip of the spear on the clean energy transition in the United States. And I think it's going to be a very, very exciting time. to be in this sector, and particularly in California.
So Calvin, I've left you with the impossible task of following Patti.
Well, I always say, first off, good afternoon, everyone. Good to see you. And Steve, thank you for having me. And I've always said this, if I'm going to do a panel, I want to do it with Patti.
Oh yeah, Calvin and I are a good tag team.
Because this is, because Patti leads in and then I just say, yeah. Calvin Butler, and I've had the pleasure of being CEO of Exelon for about 15 months now. I took over December 31st, 2022, and it has been a good 15 months. We've done a lot. As Steve talks about, my background, I'm a lawyer by training, environmental securities lawyer. I had the pleasure of doing that for a couple of years, and then I became a lobbyist. So I did government affairs for a utility company. And early in my career, when U.S. was deregulating, I was on the cutting edge of that, doing that in Illinois. And then I left the industry for almost 10 years to work for someone you might know, R.R. Donnelley. And so I was handling government affairs for Donnelley, and then I ran two manufacturing plants, which is where I got my manufacturing chops. I ran 2 printing plants. Now, unlike Patti, my team is very clear to tell me you're not an operator. Do not pretend to be, But what you find out a lot about yourself when you step out your comfort zone. And I never pretended to be an operator. But what I learned is that early on in my career is that when you have talented operators, let them do their job, and you figure out what they need to be successful. So I ran 2 manufacturing plants, and then I came to work for Exelon. I started my career at Exelon at ComEd, doing everything non-operational. Then I was Chief Human Resource Officer for a minute. Then I did mergers and acquisitions where we bought Constellation and PG&E in Maryland back in 2012. I was the person putting that deal together from 2011 to 2012. Then I went to BG in 2013, became its CEO in 2014, was CEO of BGE for almost 6 years until I became Chief Operating Officer for Exelon and then CEO. So been at Exelon since 2008, and it's been a good run. And what I appreciate most about Exelon, and what I always start with, is Exelon's size and scale. Patti has California, which is a large economy. Exelon is the largest transmission and distribution only utility by customer count. We have the privilege and responsibility of serving about 10.5 million customers across 7 jurisdictions. Our largest utility is Commonwealth Edison, Chicago, Illinois. Then we go to our nation's capital, Pepco. We have Maryland, Baltimore Gas and Electric. We have Delmarva Power and Light in Wilmington, Delaware. We have Philadelphia, Pennsylvania, PECO. And then we have Atlantic City Electric in Atlantic City, New Jersey. And then we also have a large transmission build out, which I say 7, which we have the first jurisdiction that we're running through there. And between those utilities is why I have all my gray hair and I keep it tight, because you always have some type of regulatory proceeding going on. But outside of our size and scale, what's interesting about our company is that all of those jurisdictions, like California, are very progressive in terms of decarbonization. What are they going to do? We always say they're always trying to catch up with California in terms of their amendments and their legislation and trying to decarbonize transportation electrification. And each of those jurisdictions are doing something different. And to be in those jurisdictions, you have to understand what the regulatory bodies want. We can talk a little bit about that because you can't be a one-size-fits-all. You have to play into them about what those legislators and regulators want. In addition to that, Exelon is committed in each of those jurisdictions to being good stewards, meaning community investment, workforce development, economic development. That's, I think, what separates us from a lot of our peers is that we show up differently and we become partners. And being a transmission and distribution only company allows us to do that differently than when we used to. Now, for those of you who may not know, Exelon spun off its generation portfolio in 2022, February of 2022. We owned Constellation, which is the largest nuclear operator. And by spinning that off, it allowed us to show up in a different way. very authentic way to partner with our customers because we were agnostic as to how they were going to get their generation, whether it was solar, wind, nuclear, because even though I would say I was agnostic, they would say you're really talking for the nuclear company. So this has allowed us to be very different partners in our jurisdictions, and it's going well. So I look forward to this conversation,
Yeah.
but that's a nutshell of who we are.
Well, let me go back to the intro I made, which is stocks haven't been doing very well, but in many ways it's a pretty exciting time to be in the business. So maybe you could, Patti, talk to what do you think investors are missing about the business or maybe overreacting to or not appreciating? Yeah.
Yeah, I think one of the things I'm particularly excited about is that to decarbonize the economy requires the transition to electricity. Now, a lot of people, I think, aren't aware yet of the economics of electrification. And specifically in my service area, I can speak, as we decarbonize the economy and transition customers to electric transportation, that can decarbonize, that's the number one source of carbon in California is transportation. As we decarbonize transportation, we can decarbonize the economy 70% and reduce household energy spend by 20 to 30% simultaneously. So I think a lot of people think the clean energy transition is going to be more expensive for people. It's only more expensive for people left behind. And so our job is to make sure that we enable that clean energy transition for all. And the ability to build out that infrastructure at this time, I think, is the opportunity of generations. You know, we have, over the last 20 years, as a sector, had basically flat load growth. With data centers, electrified transportation, the opportunity for increasing demands, electrifying homes, we have the opportunity to have significant load growth that can help fund that transition in addition to just a more efficient fuel of electricity versus gasoline for cars. So those two things in combination, I think, mean that infrastructure investments in our sector are going to be significant and affordable. And that's the part that I think people are missing. They don't understand the affordability part because I think we as a sector haven't done a good story telling the whole picture. And so we're definitely focused on making the case, and I do think in California, because we have a very unified front in California, if you will, politically. And what I mean by that is they're not going to be swayed by this year's national politics in the United States. We have clear ambitions on decarbonizing, and nobody has gotten nervous about that or weak-kneed in California about that. We're going forward, and we'll be the energy provider to shepherd then our state through that transition. So I do think we have a great opportunity, and we take a lot of responsibility to do it right. And so doing it affordably is going to be an essential ingredient in our transition in California.
Calvin, your thoughts on that?
Yeah. No, Patti is right. And I would tell you, Gene Jones, our CFO, is always saying about what Exelon has the opportunity and the privilege to do in terms of lengthening and strengthening our investments. You know, you think about this, is that I shared with you in each of our regulatory environments, every one of them has passed legislation. To Patti's point, this is not a federal play. Every one of them has passed legislation to decarbonize and to electrify the transportation sector. So I think what people are missing is that this is going to happen, and don't get caught up in the news bite and understand this is a long-term play. We had a bad ruling in one jurisdiction, but yet we still increased our capital spend over the next 4 years by over 10%. And we're doing it in partnership with those regulatory bodies. In all of our jurisdictions, they're forward-looking, so I don't invest $1 before the commission has already given the green light. People miss that because the headline doesn't say it. So, and it is a long-term play because I like to refer to this is a multi-decade transformation. It's not something that's going to happen over the next 3 to 4 years. This is going to be one of those where we're going to be continuous partners, and we as utility companies, energy companies, have the chance to really set the pace, work with those regulators and legislators, because my number one job, I think, outside of keeping the lights on and the gas flowing, is ensuring that this transition is equitable across the jurisdictions that we serve. Because this is what I can tell you. If it's not done equitably, they're going to slow it down. So you have to always put that at the forefront. And the equity piece is really around affordability and access. So that's what I'm talking about when I'm telling affordability and access. If you outrun your customers, they're going to pull you back. So we're in a good position with that issue. But at the end of the day, I think because it's a long-term play, we don't get the benefit in that stock price. And I lost almost $4 billion in market cap on December 14th because of a ruling in Illinois. And that was the headline. And but we, as a company, because of who we are, we were able to maneuver and get things done and still meet the expectations of what we were trying to do. But that's where it would happen, Steve.
Yeah. You gotten a decent amount of it back, just to.
Thank you.
Yes.
Thank you. We have.
Still time.
Time will tell.
And you know what? And what's going to be is not only have we gotten a decent amount of it back, we're still just scratching the surface of how we're going to continue, because to Patti's point, they can't do it without us. And they've passed legislation saying what they want to do. So my job also is saying, this is what you want to do, but that you're making these rulings just contrary to what you're doing. And how are they not aligned? So let's talk about alignment. So that's really what we're working on.
But I'm going to switch order
Oh, please.
of focus just because
Yeah.
regulatory came up, and maybe just Calvin on that point in Illinois, you talked to it a little bit. Just give some perspective on the overall regulatory, how you feel about the overall regulatory environment, of your states and specifically Illinois. How should investors kind of perspective that? Because on the surface, it's just like, wow, that's just really a bad order. But obviously, there's reasons and things change, and
that's true.
probably things under the surface.
On the
yeah.
surface and even deep down, it was a bad order. It was a bad order. And the part that was most frustrating about it is that it didn't make sense. If you can rationalize and kind of say, let me connect the dots on it, you're like, okay, I get it. I see how they got there. We'll work around it. But it really didn't. And I used the analogy, and it was one of our colleagues, where he says it's like if you're in a baseball season's about to start, so I'll use a baseball analogy. He said, how umpire makes a bad call, and they know it's a bad call, but they're not going to tell you it's a bad call, but they're looking for a way during the game to make it up to you. This is what I feel Illinois is doing right now. They're showing little ways about how can we, because we made a mistake. It was bad. But that's okay. So the regulatory environment in one jurisdiction is not going to set this tone for Exelon, because I've always said our business principles and the business model works. So the same day that I got the bad order in Illinois, I got one right down the fairway in Maryland. Same exact day, December 14th. I settled 2 rate cases in Delaware and in New Jersey in 2023. I've got 2 rate cases going on right now in Pepco DC and Pepco Maryland. I'm going to be filing a PICO rate case this year. We'll most likely settle it like we have been. So the jurisdictions are good. 100% of our rate making is forward-looking test years, meaning that they're very proactive in nature. And again, we don't invest $1 before we get approval. And that's the upside about Illinois. It was that bad, but I was able to take capital out without committing to it. They said they wanted us to do X, we'll do X. But understand, that transition that you want to make to keep up with a California is going to be much slower because you've made the rule. In the old days, you invest it, and then they tell you, no, you can't recover. Now we've changed that model where we won't invest $1 until you say it's okay. So that's where in each of our jurisdictions and what we're doing. So I think we're on course. We continue to tinker around the edges on our jurisdiction. We don't take them for granted. And we will continue to push forward on, tightening them up. And Illinois is the focus right now.
Patti, maybe just on California. So you were new to California regulation when
Yeah.
you came, and I think you've talked about, well, impression was it was always kind of noisy and loud. But what's your thought now that you've been there for a few years.
Yeah, you know, what I know about the California regulatory construct is it is excellent if you execute. We have a saying, performance is power, that when you perform, you have the power to expect good outcomes. You have the power to earn the respect and the trust of your regulator, but you have to perform. And so that's why this operational turnaround is so fundamental to PG&E. We do have a lot in the construct to appreciate, and there's some things probably that are misunderstood right now about California's regulatory construct, and particularly as it relates to wildfire. I think a lot has changed in California as it relates to wildfire regulation and legislation. And so I'll just hit a couple high points on that, if that's okay. Especially in the context for any of you who, I mean, we pay very close attention, but Warren Buffett's letter that came out, and he talked about the investability of U.S. utilities and his concern about it and the risk-reward portfolio. We think he got California wrong. I believe he got California wrong. I think he's not up to date with the changes that have occurred in California from a regulatory and legislative perspective. We've got a legislation that was passed called Assembly Bill 1054 that protects investment in California in the event of a catastrophic wildfire. That did not exist before. And so at the highest level, we have dramatically reduced the risk in California, both physically on the wildfire risk and financially, because of that AB 1054 protection. It protects in fact, our exposure in the event of a catastrophic wildfire now in California, our investors' exposure is about $50 million in the event of a catastrophic wildfire. That's dramatically different than it was when PG&E went bankrupt. The construct has several elements, but the most important thing is that we do what we say we're going to do on our wildfire mitigation plans. We file them, they get approved, we do that work, and as long as we've done that, we have a safety certificate, and that allows us to access a state fund that then protects and covers the liabilities associated with that. That's a very important change in California, and it comes back to a fundamental requirement that we perform. And so that's why performance is power is such a fundamental tenet of our turnaround, and why when you have that, you combine that, the protections from the wildfire risk with just the elements of the regulatory construct in California that includes, we just had approved a 4-year forward-looking rate case that covers revenues through 2026. That's a lot of certainty in an uncertain time. We have decoupling, we have protections for cost of commodities. There's a lot of support in this regulatory construct that just requires that we do what we said we're going to do. And I like those odds. I'll take those odds all day long. We perform, the construct delivers.
That's great. Well, I'm gonna end with one last topic, which is the hot topic.
Yes, I thought I just covered the hot topic.
That was the second hottest topic.
Yeah, okay. That's amazing.
The hottest topic is obviously AI and data centers.
Oh, that is a hot topic.
In the U.S. It's pretty much about 95% of the calls I get, at least. And there's been a few stocks in the industry that have benefited, most have not yet, but obviously I would think that most utilities are going to be serving data centers and participate in some way. So maybe you could talk to your perspective, maybe Calvin first, on how that's impacting your business and the opportunities there, and then Patti, and then we'll open it up for questions on everything.
Well, for a long time, we were in a load growth area where it was flat at best. And we are now speaking, I think we even talked about it on our fourth quarter earnings call, where we have a market within our jurisdictions that data center growth is a significant piece of our business model. Now, what I can tell you, I don't think there's been any new data center built in any state that has not passed a tax incentive to give them some type of rebate. And California is doing it. California hasn't had one. No. So you think
and
about.
We built them. Yeah, we're building them.
So you think Illinois, Pennsylvania, Virginia, and the like. We have seen in Illinois alone where we're looking to add about 5,000 megawatts of new data centers growth in Illinois. Now that comes for a reason, right? Illinois has a clean stack generation where nuclear baseload, reliability is the best in the nation, and ComEd, and the rates are roughly 17% below the national average for large cities. So all of that plays in of why ComEd. And then you have the land. Pennsylvania, same thing. Maryland, same thing. And in addition to that, what this does, and let me just take it from not just data center growth, but also transmission build. In the last year, we got awarded from PG&E an $850 million project to build a transmission line running across 3 of our jurisdictions. So in U.S., what you hear is that building a transmission line is very difficult because of the siting issue. But that transmission line, all 100 miles, only 1 mile does not exist on our right-of-way. So when you look at our footprint, again, data center growth, connecting, transmission build-out, so forth, all of this plays into us. In addition to that, we're also seeing build-up of not just data centers, but on the AI side, you know, manufacturing plants, what we're also, the technology, solar, all of this is going into high electricity demand that we're seeing that's going to double. And so for us, being in the position because of our affordability and reliability puts us in a very good position across our jurisdictions. But it is something that we are working with the right regulatory bodies to make sure they get it right. Because if we do not plan for it appropriately, it can come back at us. And let me just give you one example before I turn it to Patti. In Virginia, you know Dominion, they were the data center hub in the US. And they didn't plan for it, meaning the regulatory body didn't plan for it, and they got overbuilt. And that's a lot of that data center growth that would have happened in Northern Virginia went other places because of that. And this is what we're seeing right now.
Yeah, so I would say one of the most pleasurable things about my role is getting to serve Silicon Valley. So that is an amazing service area, part of our service area. I'll step back just a second, and then I'll hit the data center growth and why I think it's one of the things misunderstood about the sector and what the potential is. But if I step back, we have we call it our simple, affordable model and it's a critical part of our investment thesis. We have industry-leading rate-based growth at around 9.5% per year, forward forecasting for the next 5 years. That build-out is only affordable for customers if we have 3 key components. One, that we reduce our operating expense, and we're doing that every year. Our lean operating system is enabling us to reduce our operating expense. In fact, we reduced it. Our target is 2% every year. Last year we did 5.5%. The year before we did 3%. We're building the muscle, that operating expense offset, and load growth. Any load growth can help fully utilize existing assets and help fund that capital build out and help offset costs. As Calvin said, you know, the industry has seen flat load growth for decades. We're now seeing the actual load growth materialize in our service area with electric transportation, electrification of buildings, as well as now data centers. We have almost 1 gigawatt of current orders that we haven't yet built the capacity and transmission for. Then we offset it with more efficient financing, which for PG&E, we have a very good pathway to having more efficient financing than what we've been doing since post-bankruptcy, as you can imagine. Pathway to investment grade helps customers a lot. So those combined offsets, O&M reduction, load growth, and more efficient financing allows us to have this industry-leading CapEx and rate-based growth at a price customers can afford. And so we're at an expected CAGR of bill increases in the 2 to 4%. And in fact, that rate case that we just had approved, a 4-year rate case, has a 4-year CAGR of 2 to 4%, closer to 2 than 4. In this high inflationary environment, that's an important commitment to be able to make to customers. So then we say, do we have the potential to build data centers? You bet we do. And what a great opportunity. In fact, just 2 weeks ago, I was at something called our Metcalf substation, which is sort of a legendary large transmission substation. 60 Minutes is a TV program in the United States that profiled Metcalf sub as one of the critical transmission substations in the United States that backs the grid because it was shot up by some guy up on a hill. But that's a story for a different day. But the point is that the substation is quite spectacular. It's 500 kV, 230 kV, and 115 kV in this very large facility. And we invited customers, which we never do, to attend. And so this is who I hosted 2 weeks ago at Metcalf Sub. AWS, Google, Microsoft, Apple, Tesla, Equinix, Western Digital, Stack, all of the big data center builders, owners, operators were at Metcalf Sub. Why in the world did they come to Metcalf Sub? Because they want me to make it bigger. And they want to invest in data centers in California. And I think this initial pursuit of lowest cost energy, they've realized they've met their limit there, and now they just need to build out these data centers. So I do think it's misunderstood for the sector, but certainly for us in California, we can't wait to serve that load, and that's going to be a great part of our growth engine that helps to do that middle piece of our simple, affordable model, and that's load growth.
Great. Well, let's open to questions from the floor. So, Rebecca?
Just for Calvin.
Please.
You talked a bit about the regulators knowing that this was a bad decision in Illinois. Can you talk about some of the implications of that decision that's been visible to them, and also what levers you have within your control to make sure Illinois is not a discount state going forward?
Yeah. So there's a couple of things. One of the first things that came out, we let it be known that this is going to cost jobs. We had the IBEW, the International Brotherhood of Electric Workers, the unions, came out very aggressively. And it wasn't just us, it was all utilities, electric and gas in the state of Illinois, that this commission has taken this step on. And I'll just give you a magnitude of what our contractors have been impacted. 900 direct contractor jobs and over 2,200 indirect contractor jobs. They're telling them, you know, you passed this law, the Climate Equitable and Jobs Act, but yet you're losing jobs because of a commission ruling. So that has been very clear. Matter of fact, last week, the international president of the union wrote a letter to all the legislators and the governor talking about this exact issue. So that's been very open to them. Two, we reduced, and help me here, Gene, we reduced our capital plan in Illinois by roughly $1.2 billion in distribution investments in Illinois. So again, that's jobs. But we were able to put $700 million additional capital on the transmission side in Illinois, and then we shifted those dollars to other jurisdictions that were ready for this transition and passing the right regulation to get it done. So as I talked about, we increased our overall capital plan despite Illinois going down by almost 10% to $34.5 billion over 4 years. But it's been very, and then we also said to them, look, we've always been good partners in Illinois. You obviously don't appreciate the partnership because it works both ways. So all the things that you come to expect from us, we can no longer do that. And I'll just give you one simple one. Illinois is hosting the Democratic National Convention this year. And you know, as soon as Chicago won it, they came to us about being a sponsor, and we were all in. But we let the governor know we can't do that. I cannot lay off workers and then put a couple of $1 million for your convention that's coming to the state. That's not a partnership. So he's getting the message, and I was sharing with Steve earlier walking up here, is that I'm never going to be that guy that, you know, goes right at him. Our actions will speak louder than anything that we have to say, and we'll give him a chance to, because you don't want to back him into a corner, but he has to get the message that this is not the same way that we're going to continue to play this. So those are a couple of examples. Okay. You're welcome.
Thank you. My name's James Spence. Hey, this question is probably for Patti. I'm intrigued. You've talked a lot about the load growth, obviously, that's coming in California. We heard the last speakers on the last panel talk a lot about the challenges of firming in Australia and New Zealand. What does that look like in California? How are you going to manage peaking and firming?
Oh, yeah, okay. Sorry, I didn't think I heard you properly. So firm capacity to supply the demand? Yeah. So a couple things. The generation mix in California, which has gone definitely to the decarbonized direction, we have a lot of additional capacity on a daily basis. We have a handful of peak days in the year where we're tight on capacity. And all of the additional storage that we are adding is a key enabler. And this is one of the things I get pretty excited about the distributed energy management system as it relates to delivering on the peak capacity, so that on any given day we can deliver the firm supply for any demand that exists. Data centers, obviously a big base load demand, but we see the opportunity to serve that additional peak, which is, again, very short in California, with additional storage. And so we're showing over and over again where storage becomes a solution, and specifically storage from electric vehicles and the electric transportation. This is one of the reasons why I'm so bullish on electrification of transportation, because it's the first load that has these two features. It is dynamic demand, so you can time people and give them the proper signal to charge at the right time, and it is a form of supply. So here's just an interesting statistic. On our roads today in my service area, we have over 6,000 megawatts of capacity in EVs that are on the road today, right now. That's not a forward forecast. That's today's vehicles, both from an interrupted charging perspective, but imagine them and the new vehicles that are coming out today that are bidirectional. So enabling supply from vehicles as a resource. We are launching the first distributed energy resource management system on the cloud with Schneider Electric and Microsoft that allows for the optimization of those distributed resources in a way we never could before. So I think there's that, and I would also say that our state legislature has realized that they want that firm supply. And so, for example, we have a 2,200 megawatt nuclear facility, Diablo Canyon. The state legislature had directed us to decommission that plant, and they just reversed that. So we're going to actually extend the life of that facility. We have a 5-year horizon now, but we're filing for a 20-year license with the NRC. So I think there will be a lot of technology solutions and leveraging those distributed energy resources in a more dynamic way that will really enable that transition to happen.
Yeah, g'day. Conscious I'm kind of deferring drinks for everybody, but kind of ask a question that hasn't come up for a couple of years, but just your perspectives on the role of gas in the energy transition, given that you have some LDC and gas customers as well, and cheap gas too.
Yeah.
So understanding, I gave you the blueprint of Exelon. 12% of our business is gas. We operate between 3 LDCs that have that. And we invest significantly in replacing our old gas mains. And by 2042, we will have every cast iron and old main replaced. That's very important, not only for cleaning up the grid, but also, or the stack, but also ensuring reliability and safety. We have truly, Patti and I were just talking about this, is that I believe in the portfolio approach, gas is a key part of this transition. Because for one, safety, reliability, and affordability. And going back to that equitable discussion that we were having earlier, and we have done studies where we've had some counties within Maryland specifically talk about all new development being all electric and transitioning from, and then we had to put it in front of them in real time. Again, I benefit. If you go away from gas, I'm building new substations, I'm hardening out, so I actually grow. So I can tell you, look, I make more money if you go all electric. But think about your constituents and the customers. It will cost them more, almost doubling their bill in real time. And in the time frame that you're looking to do it, it's really impossible to build that many substations in the time. So once you put out the facts, and it's not just my facts, we actually hired a separate consultant that the commission had used to lay out the facts for them, and then we walked them through it. So bottom line to your question, I believe gas is going to be a considerable part of the future.
So I also believe gas will be a part of our business for a long time. However, we are pretty excited about our ability to transition customers on a very targeted way. We have one of the few overlapping electric and natural gas distribution service areas. So just as Calvin said, we're agnostic whether customers use natural gas or electricity. In fact, in some ways, we have better margins on electricity. There are cases where transitioning people, and we do have communities who have the mandates to go all new construction is all electric, et cetera. Because we don't have a heavy heating load in most of California, it doesn't have the same negative economic impact that Calvin described. But we've identified certain cases where, for example, we were doing a motorhome park that we were going to be replacing all of the service lines and the main as part of our infrastructure upgrade. It was going to cost $30,000 US for each premise. Well, that was cheaper for the customers to actually electrify those customers and remove the main and the service lines. So where we can have opportunities for economic targeted electrification, we're doing that. We're also continuing to invest in our gas system. We do have a renewable natural gas standard in California of 15% by 2035. So we've been working that pathway. We're not sure there's enough RNG to do that, but we're certainly partnering to try and make that happen. We've got support to do that transition, so we're certainly looking at that. But I do think natural gas, particularly for peaking generation, can play a very low carbon way of providing that resilience that we've talked about. And there's I think, very smart opportunities to maintain that even in California that is continuing.
And what you're also seeing, the federal government is trying to step in, because not only are we talking about the heating, replacing people's appliances and so forth. This is all playing into the cost of this transition. And federal and state governments are leaning into that discussion because they're going to have to be involved in some form or fashion.
Other questions? Well, I will leave the floor, Patti and Calvin, to you for any last comments for the audience.
Thank you.
Before we go have a drink.
Okay, well, heaven forbid. I'll try and make this brief. Number one, I do think, as we like to remind people, the turnaround is on track at PCG. We're proud of the progress we've made, but we aren't done yet. And the transition that we are leading and the transformation that we are leading, this turnaround, really creates a lot of value for both customers and investors. Our simple, affordable model is at work, and it has a lot of runway. I'm proud of the team for their adoption of our performance playbook. And that performance playbook is delivering consistent, repeatable outcomes that customers can count on, and so can investors. So the infrastructure investments that we're going to be making at PCG are sizable and affordable. And we think that's an exciting time. I'd say, I think we're, as I've heard others say, we have the highest industry growth with the biggest industry discount. So if you're looking for a sale price, PG&E, I think, is really, I'm very proud of the company that we're building, and it's a company that we're building to last. And so I look forward to furthering our conversations over the years to come and talking about our differentiated turnaround and what it's delivering for customers and investors.
And let me just begin by saying thank you. And I know many of you met today with Gene and Andy, and you hear it. What is Exelon's scale matters. It matters, and I can just go back to what we just experienced last December, is that one bad order does not take away the business philosophy of this organization. And investing $34.5 billion over the next 4 years with an earnings growth of 5 to 7%, commitment to meet the midpoint, and pay out dividend, you know, we're going to get a total shareholder return between that 9 and 11% with a low risk profile. We have the lowest risk profile of any of our peers. Our downgrade threshold is the lowest of the industry, and it's for a reason. That out of that $34.5 billion in capital investment, not one project accounts for more than 2% of that total investment. And that's recognized by the rating agencies as well. That low risk profile, that earnings growth, and that commitment to operational excellence is who we are. And when you look at that business model for us, we can partner with our jurisdictions differently. So when Steve starts off, it's like, why is the investment thesis for utilities? Because we truly approach this at Exelon and others as a long-time play. This is a multi-decade transition. My commitment to you is that we're going to meet our commitments, but we're not going to do anything stupid along the way. Because we are going to be partners every step of this transition. We're not going to outrun our customers. We're not going to make short-term decisions for immediate hits, because we're going to play this out. And that's what you get with an Exelon. But you will get some gray hair because of all the jurisdictions. You will. But balancing those jurisdictions is what we do. Let me give you, I'll close with this. When we first bought BGE in Maryland, BGE was earning 5.5% ROE, was in the third and fourth quartile in operations. It's now in the first quartile, earning 9.5% ROE. When we first bought Pepco DC, PHI, it was considered the worst utility in the nation, in one of the worst regulatory environments. Now it's operating in first quartile, both customer sat and operation, and earning 9+% ROE. I share that with you because we know how to turn bad jurisdictions around. It may not be as quick as you would like, but we'll get there because this is what we do.
That's great.
Awesome.
Well, thank you
Yeah,
both.
thank
Appreciate
you.
it.
Thank you very much.